10, and I was questioning, is this the top of the bull market? In years past, I think I got here at 8:30 or up 9. But I'm on the board of trustees, and we take your role very, very seriously and have for about the last 7 years or so. 8 years. The former chairman and my classmate, Russ Ramsey, and his wife bestowed upon this class $1 million, and it's real money. It's not paper money. And the Board of Trustees knows that you take your role very seriously, and all the prior classes, as well as the two professors here. So we watch the results, but we also look at perpetuity and know that this type of a class is absolutely right on the mark when it comes to looking at value over a very long period of time. So with that, I'll be a great listener. Every time I come here, I've learned something. I'm on a 2-hour meter. That's as long as I'm staying, despite the fact that they told me they'd give me a parking pass. But I'm old school, so.
All right. ExxonMobil. Okay, the clicker. Do you want the microphone?
Clicker's up there.
We just have to stand on this.
No.
You don't have to stand. You can stand anywhere you want.
Oh, fine.
But if you start to wander, you should just be mindful.
And then when you're ready, hit the start button, so watch your time here.
Okay. Let me stand on mic.
Wherever you'd like.
Okay. All right. Good morning. My name is Laura Schoenfeld, and I'm here to talk to you about the energy and utilities sector. It's pretty intimidating to go first, but I'm excited to kick us off. I'm going to recommend that we buy ExxonMobil and that we sell C&J Energy Services. Just a quick overview of all kinds of companies that are in the energy and utility sector. Today we're going to be focused on major integrated oil and gas equipment and services. So we'll go right into the buy recommendation for Exxon. ExxonMobil, I'm sure you've all heard of it, is an international integrated oil company comprised of 3 main portions. Upstream, where they explore for and extract oil and natural gas. Downstream, where they refine them into usable products and sell them to the end user. And chemical, where they create industrial and consumer chemicals. As you know, everything that ExxonMobil does is necessary to power the world economy. Not only are they in the oil and gas business, but also think about how petroleum is used every day in all of the items, plastic items, coffee cup tops, all of that kind of stuff. So even though when the economy is down, people will buy less of their products, there's really a limit to how much that is going to drop. So they're in an excellent business. In addition, they are the 2nd largest company in the world by revenue right now, and have a very strong market share and brand recognition. This is the overview of the stock price for Exxon in the last year. As you can see, they are near a 52-week high right now. There was a major trough from August to October of this year because of disappointment in 2nd and 3rd quarter earnings. But the price has gone back up because analysts are predicting higher oil prices and therefore higher profits for Exxon in 2014 and 2015. In addition, Warren Buffett's large stock purchase of Exxon in November has pushed the price back up. But as I will argue, I think there's still plenty of room for value for us to gain value by buying ExxonMobil. A quick overview of where they fit in with Porter's 5 forces. They're in a very capital-intensive business, and they have the most assets and are really kind of the winners out of everybody else. So there's a very low threat of new entrants. They have a lot of power over their suppliers. They have some issues with competitive rivalry because all of these major integrated oil and gas companies are working to be more efficient and to fight for all the reserves that are left in the world. So they need to make sure to watch out about that. But I give them an A- for their business. I think they're in a great business and they're very powerful within the industry. Next, I'll talk about management. They have extremely experienced management. Most of their top executives have been with the company for 20 years or more. In addition, they've done extensive share repurchasing in the last decade especially. They've repurchased 1/3 of the shares outstanding, and even in the first 9 months of this year, purchased $12.7 billion worth of shares. That shows that management is really confident in the company, and I think that's a great statement for why we should buy Exxon. They've also had limited recent controversies. They seem to have gained a lot of lessons learned from the Exxon Valdez incident in both safety and environmental issues, and their competitors are suffering from a lot of negative publicity right now, including BP with the Gulf oil spill and Chevron with issues in Ecuador. One issue I have with Exxon is they're not very forward-thinking about what to do with the finite resource of fossil fuels. Fossil fuels are eventually going to be too difficult to get out of the ground, or too difficult, or too expensive, and they're not really talking about renewable energy or what the future holds. So for that, I give them a B+ for management. Their balance sheet, I compare them to Chevron, which is one of the companies that I covered this semester, and I think is a really strong company that I'm happy is staying in our portfolio. The Chevron is great, Exxon is even better on a lot of metrics. Their credit rating is the highest from Moody's, the same as the United States government, which means that, as I'll show you with price, I think there's a good chance for an upside with extremely low risk. Revenue-wise, you can see they're about double as large as Chevron last year, and they both, ExxonMobil has even stronger ratios for ROE and ROA and cash flow of operations to debt than Chevron does. So that gives the balance sheet an A-. Finally, price and value, as of this week, it was 94.39. I think there's still space for value growth in Exxon with their very large reserves and the increase in oil prices that are going to come in 2014 and 15. I think they're correctly valued currently, but as you can see from the bottom here, with the estimated PE, I think their PE will go slightly above where it is now. It's currently at 12.19, and with the expected earnings per share, I think Exxon will be worth about $104 next year. In addition, they have a dividend yield of 2.71%, slightly lower than some of their competitors, but their dividend has grown every year for the last 31 years in a row, so I think that's a strong argument for us as shareholders. So I give them an A- for price and value. There are a couple risks to purchasing them. Regulations in the US and around the world can change easily. Environmental issues and protests can slow down operations or even sometimes shut down projects. Research and development progress, they need to make sure to stay on top of their research and development. As oil and gas get more difficult to extract, they have to continue to be a leader, and they need to think about renewable energy. But I still think of them as a strong buy and with an A- final grade. Now I'll quickly go through our sell, C&J Energy Services. They are an oilfield services company, one of 4 that we own in the portfolio, which has not allowed for great diversity. They are mostly focused in hydraulic fracturing, so extracting natural gas in the United States. And you can see they're really a small player compared in an industry that is mostly made up of a couple of huge players. You can barely see them on the graph compared to Schlumberger and Halliburton, 2 of the big players in their industry. They also have limited opportunities with natural gas right now. The natural gas market in the U.S. Is heavily oversupplied, and so the price is very depressed, while the price is very high in Asia and Europe. But the United States has limited the ability for companies to export gas, at least right now. So they're basically sitting on this asset that's not worth very much money, and they don't really have the other businesses to help them weather the storm. They do run other businesses, but more than 70% of their revenues are from natural gas. Many countries that we even have agreements with, like Mexico, where they're building pipelines and going to be supplying natural gas-fired power plants, those are not going to come online until 2017. That's kind of a long waiting period if that's your main business. Stock price movement in the last year, it's near the 52-week high, but unlike Exxon, I don't think that there's room for growth, which I'll talk about a little more later. They have a very weak moat, again, being a bit player in an industry dominated by giants. They do not have a lot of control over many of the different outside forces that affect their business. So I give their business a B-. Management, they have experienced executive management in the industry. Many of their top people came from Halliburton, but very limited experience running CJES, which I think is a concern. And also, they're not doing a lot to really explain what's going on with the plans for between now and 2017. How are they planning to make money off this asset that's not really worth that much? So although they're not over-promising, I think that's a concern, so I give them a C. For balance sheet, again, I compare them to another company that we have in the portfolio, Schlumberger. My big concern is they are not even rated. They do not have a credit rating currently, which is going to limit their financing all through bank loans right now, and it's really going to limit their ability to grow if they are not rated. In addition, you can see how small they are revenue-wise compared to a giant like Schlumberger. And although they have good ratios, I just don't see how they're going to be able to successfully make money. So I give them a B on their balance sheet. Price and value, the price this week was $23.80 a share, and I think they're already overvalued today with little room for growth. They have no dividend and very volatile PE. They're currently at 14, but last year they were at 4. Their average has been 6. So looking at the bottom again, I see the PE is probably going to, my guess is going to be somewhere between 11 and 13 next year, and with the estimated EPS, I think the stock is only going to be worth $18 or $19 a share next year, which is a good argument for selling now. So I give them a C+ for price and value. There are risks. The company could gain market share or export regulations could change quickly, but unlikely. So I give them a C+ total. To round it out, I think we should buy ExxonMobil. I think we should sell C&J Energy Services. Again, I think the dividend at Exxon is going to make us happy shareholders. We're not going to make, it's not going to be astronomical growth with Exxon, but we're going to make steady returns without a lot of risk. They have deep pockets to weather the storm. Opportunity cost of waiting until 2017 for everything to come online for CJES is an issue. And again, it's going to diversify our portfolio. We only had one major integrated oil and gas. Now we'll have another one that has global reach and be able to get rid of one of our oil field services company. 3 seconds.
Well done.
Okay. Thank you, Laura. Thank you for going first. Questions?
Mr. Ross?
What's the downside risk in Exxon? Where do you see that if we went through a funk?
You know, I mean, I think we're investing in energy and utilities still. So if we went through a downside, I mean, Exxon could drop below where it is now, and that could hurt us. But I think, first of all, long term, they are going to continue to grow steadily. But I think that if there's a downturn, everybody's going to suffer, and that Exxon is going to suffer less because of their deep pockets and ability to, and just their global reach. Varun, did you have a question?
So you mentioned, so what are other business ventures is Exxon going into to try to anticipate, the hot box fuels that are essentially going away?
So they're really not. The most green things, I mean, everybody says they're doing green things, but the most green things I could find was that in their chemical division, they make a lubricant that is used in windmills. That's what really say to me that they're taking it very seriously. So if that's the greenest thing they're doing, I think, what happens if your business model is selling products that eventually aren't going to exist anymore and you're not thinking ahead? I mean, I don't think in the next 5 years that's going to affect the fund, but 50 years from now, you either are going to have some big problems or have to make massive changes, and it seems like incremental change would be easier.
It looks like C&J Energy is an expert in hydraulic fracturing.
Mm-hmm.
Does Exxon have that capability?
Yeah, they have a large hydraulic fracturing business unit, and they are more diversified because they're working in a lot of other countries that have less limited regulations on export. So, for instance, one of their big projects right now is in Australia, and I don't know a lot about Australian export regulations, but I assume they can't be stricter than the U.S. So they are able to, they're getting natural gas out of the ground in places that need the natural gas, as opposed to if you're just concentrated in the United States, you're kind of stuck here in this depressed market. So.
So I was looking at the stock page summary that you have, and it looks like the growth estimates over the next 5 years for Exxon are under 2% versus C&J is about 12%. So I was just wondering, why does Exxon have more upside? Is it are you really making this recommendation to hedge against risks, or is there actually more upside for C&J than there is for XF?
I mean, I think C&J has an opportunity, these smaller companies can make changes and can grow and are more nimble than the big companies. I don't doubt that. But that's an analyst's estimate, and I just don't understand how they're going to make money off of something when they have no market to sell so even though that's the analyst's estimate, which I put in here,
So that wasn't your estimate?
No, that's from Yahoo Finance. I don't agree with that estimate. And again, I hesitated a lot, and they could tell you about this. Exxon seems like a safe bet in a lot of ways, but I think how is CJES going to grow if they can't how are they even going to finance their growth? They need a lot of steps towards that, and why aren't they talking about how they are going to grow? Or I think those are concerns. Exxon is not, we're not going to make 20% returns every year. I know that, but I think it's going to be steady growth, and the dividends are what this fund is looking for more than I found the hottest internet stock, and we're going to 50% this year, but who knows what next year will look like. So. I don't know who to choose.
Down in front first, lady
Okay.
first.
So you mentioned that company invested in purchase the company stock that is that company issuing any cash to fund the share.
That's actually a good question I don't know the answer to. I believe they're just repurchasing it without issuing debt with cash, but I'm frankly looking at that in the past year.
Yeah, I was just wondering how much public opinion affects their stock. Like, to a certain extent, obviously it will. If they get a lot of bad press, I don't care if they get bad press. I just want to know, does bad press actually do anything to their bottom line of their business?
Yeah, I think bad press, I guess there's a difference between the bottom line and the stock price, right? I think that bad press isn't really going to affect their bottom line. Some protests and things like that could affect some of their operations, which could eventually affect their bottom line, but I think those are still pretty insignificant in the grand scheme. Bad press can affect their stock price, but they have less bad press than all their competitors. Now, who knows what tomorrow is going to be, but I think that, and they talk about, just kind of like they talk about a lot of the green stuff, but I do think they talk about this culture of safety, and they haven't had, they've been sued a million times since Exxon Valdez, but they haven't had any major issues like that in more than 20 years. So, seems like they're doing a good job, but you never know what will go up tomorrow.
Last question.
So I'm looking at this, the company that you're trying to sell, CJES, and you focus on a lot of the export and the profits, but what about using the resource internally? Because I know that there's a clean energy folks is trying to build out that natural gas highway. Have you really looked into that when you do research regarding selling this stuff?
I had not gone fully down that road to do research, so I think those are other good questions. CJES is not terrible. I think that they are fine. I would probably recommend holding them to see what they would do in the next year, but we had to sell one of the, I know it's not really starting an argument, we had to sell one of the 6 stocks, and I felt that they were the most limited within an industry that we already have, is overrepresented in our portfolio. So I think that's a good question though to look into.
Okay, thank you. Good job.
Good to go home now.
Thanks for going first.
No.
I'll wait for
Daniel? A company based in Frederick, Maryland here?
Yes, keeping it local.
You want to say something? Here's your clicker. When you're ready, tell me. I'll hit the start button. Watch your time. Here.
Go all these up or?
No, it should just be next. Whoops.
Oh, you're opening one.
Yeah, so it should just go back. Yep, there you go. Just forward.
Hi, good morning. I'm Dan Pugliese, and I cover the energy and utility sector this semester as well. Today I'm going to be recommending that we buy U.S. Silica and sell Halliburton. General investment thesis here is to add more exposure to the portfolio to the shale gas boom in the U.S., and specifically doing this through a key supplier to the fracking industry. And I believe U.S. Silica is better positioned to do that than Halliburton currently is. I'm going to be presenting the buy and sell thesis using the VMVP framework. And we'll get right into it with the business of US Silica. So US Silica is a producer of commercial silica, which is sand. Sand is a very key component to the fracking industry. And as you can see, fracking and US shale gas production has gone off the charts in recent years. And with that, US frac sand production has also increased exponentially. And the growth in shale gas production is not projected to decrease anytime soon. And with this increase in shale gas, the revenues for US Silica have also gone through the roof. Compound annual growth rate of 30% since 2009. US Silica has two main business segments. One of them is oil and gas, the other one is industry and specialty products. This is their bread and butter. They have actually been around for over 100 years, and this is what has sustained them for those 100 years. But you can see since 2009, the oil and gas segment has overtaken the ISP segment. And in 2013, it's estimated to represent 62% of their revenues. And during that time, they've also been able to grow their margins while also growing their revenue. So just a broad overview of their asset base. One of the main differentiators in this industry is the ability to transport the frac sand, getting it from the mine to the well. And sand is very heavy, so it's oftentimes more expensive to transport the sand than it is to actually buy the sand. And this is where US Silica has a big competitive advantage. They already had a lot of logistics assets in place, and they made a lot of investments to increase those logistics assets. Furthermore, one well takes about 1 to 4 million pounds of sand. New technologies actually require more sand, not less. And every well needs to be refracked every 4 to 5 years. So even if the rate of new wells was to decrease, there's still going to be high demand for this product. Furthermore, there's very high barriers to entry in this industry. To open a new well, you need a lot of capital. You also need to get permits from municipal, state, and federal regulators. And they're actually handing out less permits now than they have in the past. And if they were able to get them, it'd take a very long time. And again, the logistics infrastructure is key, and that's pretty hard to build up overnight. So as far as revenue entrance, it's very low. So for business, I'm going to give US Silica an A. Now onto their management. When they saw the shift in the industry coming, they actually pretty much brought in brand new management. Most of the top executives are there since 2009, and they've been able to bring a lot of experience in there and a lot of oil and gas experts in there. And ironically enough, the VP of Oil and Gas had 30 years at Halliburton, so he knew that this was the better bet as well. They've set very big, very aggressive goals going forward. They want to increase their market share in the oil and gas segment by 1 to 2% per year. So far, they've accomplished this through organic growth using their cash flows to increase their logistics capabilities and also add 2 new production facilities. They're the first 2 production facilities they've added in over 40 years. They're also actively looking for acquisitions, but they haven't really made any yet, and I think that's actually a very good sign that they're not willing to overspend for any assets that are out there right now. And as you can see, their success rate has been pretty fantastic. Return on assets, return on equity, and return on invested capital, very high. So for management, I'm going to be giving them an A-. Now on the balance sheet. I like the balance sheet a lot. As you can see, current assets are very much larger than current liabilities. The one thing I really like about their financials is that ISP sales segment, which is what sustained them for the last 100 years, for the last few years has actually completely paid off COGS, and there's just a small shortfall this year, which means the revenues from oil and gas are pretty much pure profit, which is a really good position to be in. The only minor concerning part of their balance sheet is their amount of debt. 52% of their capitalization in 2012 and 2013, as of last quarter, it was 57%. However, I believe long-term, or rather short-term, this is not a big issue. As you can see the debt schedule right there, there's no payment larger than $18.6 million in the next 6 years. So there's really no short-term risk of default here. And you can see in the top right corner, the liquidity metrics, quick ratio, current ratio, and cover ratio are all very good. So I think the balance sheet is strong, and the risk of default is very low. So the balance sheet is a B+. Now on to price. For price, it's currently $35.34. Pays a quarterly dividend already. One thing I should mention about this company is, even though it's been around for 100 years, it only went public last year. So already paying a quarterly dividend, which is a good sign. I did a discounted cash flow valuation where I got $48.64 as the value, and this was using pretty conservative assumptions. An EBIT growth rate of 25%, even though over the last 4 years they've grown at 39%. I calculated their cost of capital as 7.38% last year. I used 10% for the model, and for long-term growth I used 2% just to keep up with GDP. In the bottom you can see I did a price estimate using PEs and expected EPS. The one on the right is giving the consensus expected EPS numbers a 10% haircut. I believe probably in the near future the PE ratio is going to go up as more people try to buy into this industry as they see it taking off. So you can see in the near future, if it does go up, that the returns we're going to get are going to be very nice. So given the current position of their assets and their growth potential, I believe the price is very fair. And I'm going to give that a B+, and overall I'm giving the company an A-. Now on to Halliburton. So my general sell thesis for Halliburton centers around their position in the industry. I view it as fairly unfavorable. They're number 2 to Schlumberger, and the 2 closest competitors are right behind them. There's no realistic scenario where they catch up to Schlumberger anytime soon, and that means everyone else in the industry is gunning for them. And to be able to achieve any sort of growth in the near future, they're actually moving into riskier business segments. So they're moving overseas. Historically, they've been mostly operating in North America, but they're moving overseas to riskier regions, more unstable regions, and also putting a lot of assets into deep sea drilling, which is very risky, as we saw with the BP oil spill, and extremely costly. For management, they've led successful growth over the last decade. Most of them have been there for a very long time. However, this company seems to attract more bad press than any other company out there. And in 2013, they were voted the least reputable company in the United States. So it came in 150 out of 150. Balance sheet is extremely strong. No liquidity fears here. Price right now is $50.48. The current PE ratio is 24.3 versus their competitors. That's pretty high, especially considering their position in the industry and their growth prospects. I like these other companies better, or I think their growth prospects are better. So I think you're paying too much for the earnings you're getting and the potential you're getting there. And again, I ran a PE EPS estimate for their price, and that's going with $55.64. So not much room for growth there. So I believe the price is more or less fair, possibly slightly overvalued, but I think their growth prospects are limited, especially given their position in the industry. So for Halliburton, giving the business a B, management a B+, balance sheet an A, and price a B-, and overall giving them a B. So side-by-side comparisons for them. Just a quick recap. More exposure to the fracking industry and the shale gas industry I want to add to the portfolio. We already own Schlumberger in the portfolio. They are the golden standard of the equipment and services industry. So having Halliburton, I don't know if it adds a whole lot to the portfolio. I believe management is well aware of the opportunity that's put in front of them, and they're investing to make sure that they have the best assets in place to take advantage of this. Balance sheet, I think, is very strong, and I think the price is extremely fair given their growth prospects and current position in the industry. And with that, thank you for your attention, and open up for questions.
Questions? In the back first.
Their moat is mostly attained by their ability to ship cheaply.
The moat is to not necessarily ship cheaply, but actually being able to get it to where these wells are. They're not necessarily, next to the mine.
Right.
So, it's mostly through train, and then once it's off the train, you need a place to store all the sand because you need a lot of it, and then be able to get it on the trucks quickly to the actual well. So having the infrastructure, not necessarily to do it cheaply, but actually just to do it is what separates them. And then, of course, opening the mine is a huge move too.
Okay. Also, one more about the product is essentially sand, right?
The product is just sand.
Okay.
They'll tell you it's better than just sand.
Well, yeah, right. Pretty sand. Where do they source their sand from? And do they have is there any possibility of shortage or anything like that?
No. So they actually have very good reserve.
Oh, you did.
I did. summary of reserves. So they have 15 production facilities. Right now they have 307
You guys
million
worked
pounds
this out.
of reserves and 144 million pounds of reserves that meet the American Petroleum Institute's. They have standards for what the sand has to be, and so they have 144 million pounds that meet those standards. We didn't arrange that, by the way.
It looks that way. Well, either way, well done.
So at a price to book of 6 for US Silica, do you think that's cheap?
6?
Yeah.
It's not currently 6. It's like 22 right now. Oh, price to book is 6. I didn't look too much into it. I think their assets are pretty tangible, so a 6 would probably be more than ideal, but I don't think it's a big risk. No.
I saw that their margins have gone up pretty considerably from 2010. Do you know what they were before that, and is it realistic for them to keep sustaining those high margins that they're at?
I wouldn't say it's realistic, but I don't see a big crash in those margins. When shale gas production really took off, there wasn't a lot of players in this industry, so for a bit there was a shortage in supply, and that drove up prices. But for the last year or 2 years, I'd say, the supply, there's plenty of it to meet the demand, and prices still haven't cratered. This is a product that there's only a few other companies that are as large as US Silica. Most of them are small regional players, and they'll put on a truck and ship it to someone who needs like a factory down the street that makes glass. To get to these wells, there's only really a handful of companies out there that have the capabilities to get it to the well. So right now, I don't see any time in the near future the margin's going down significantly.
The same thing on the whether you know what is possible the factor of safety. You're saying for your best target price 107.9, but your DCF is showing around 43 or something.
Mm-hmm.
So where is the factor of safety here? Is this 107 realistic, or did you take somebody's price target here?
The 107 is 5 years from now. The 48 is what I think we should be paying now. 107, I extrapolate that from Yahoo analyst estimates, and that's again a 5-year price target, not a target for this year. So right now, I think 48 would be a fair price given their growth prospects and future cash flows. So I think that is your margin of safety, 35 to 48 right now.
I think one of your slides showed current ratio of US Silica at 4.75, which company's got a high, you need a lot of cash on hand.
That was the last quarter. That's actually much higher than what it's been if you look at their annual statements the last few years. So I think right now they have a lot of cash on hand. They were able to refinance a lot of their debt, which brought in a lot more better rates, less restrictive covenants, and they have about $170 million of capital I know they're sitting on right now that they've kind of set aside for acquisitions. So they're actively looking. They haven't pulled the trigger yet. So I think that might lead to it, but that's just my conjecture.
Can you talk about the ownership structure, sort of the history there? You said they IPO'd a couple of years ago. What's the background here?
Yeah, sure. They, well, like I said, they've been around for about 111 years now, so they're by no means a new company, but in many ways they're acting like a startup given the shift in their industry. They were bought by a private equity firm late 2000s, maybe 2008 or something like that. And then they pretty much restructured it, brought in new management, and took them public last year. That private equity firm has been getting out slowly. When they went public, I think they owned 70% of the company. Now they're at 11%. So they've made a very nice profit on their investment. So they were happy to get out. And actually, in many ways, they've been selling about, I don't know, like 5 million or 10 million shares at a time. So every once in a while, the price goes down when they do these secondary public offerings, which in many ways I think is helping the value stay low.
Any questions?
Thank you. Thank you. Tommy.
All right.
Rounding out energy and utilities.
Yeah.
Watch your time here, Tommy.
Okay.
Make sure that's on, that mic. Just want to make on the transfer, yeah, the light's on.
Right?
Yep.
Okay.
So in case it gets bumped on the handout. forward.
Great. All right, let's do it.
Ready?
So hi everyone, I am Tom Joe. Today I'm just going to sell Parker Drilling Company, and I will buy New Star Energy. So just an overview, what they are and why I'm buying it. New Star, New Star Energy, they are a midstream company that transport gas and oil, but mostly oil. They also do storage. I personally believe midstream is the best position right now in the energy industry. Upstream is probably the worst place to be, and I'll explain that in a moment. Parker Drilling is exactly what I said, an upstream company that does the drilling. We initially bought the company because it was a market overreaction to a lawsuit back in April. So the stock plunged to about $4. Right now it's at $8, and I think that thesis was realized. That is exactly why the reason we need to sell it, but there's other reasons to support that, and I will go into detail. So let's talk about the business a little bit. This is an MLP company. MLP company is fairly complicated right here. So we're buying the holding company, the GP, but we want to evaluate the LP because that's the one that's doing all the real business. They're the one who's hiring people, who's transporting the gas, who's storing it. So all the financial data that I provided and the business are talking about the LP. So we're going to buy the GP. I'll explain why in a little bit more. I've talked to Mr. Keating on that. So all their pipelines and storage are concentrated in the PAT 2 region of the United States. That's the middle, down the middle. And on the Texas side, they're very concentrated on Eagle Ford Shale, which is a very, very good position to be right now. Some of their competitors, storage, McAllen and Plain All American, both of them are bigger than New Star, by the way. However, I believe New Star is the way to go. And like I said, they have 3 lines of business right now: storage, pipeline, and asphalt refining. However, that is going to be changed. Just a little background on why I think midstream is the way to go. First graph shows that little line is upstream and midstream expenditure together. Before 2005, a lot of upstream, no midstream. But now, you can see the capital expenditure on midstream has increased significantly. Same thing, this is the midstream, the gray one, is increasing. Profit margins increasing, and that's not only the best part. The best part is it will keep on increasing until like 2020 without any problem. So just background why I think midstream is the way to go. So I give the business A because, like, if you look at the revenue from these 2 lines of business, refining is huge compared to the other ones. But in terms of profit, it's actually negative. They've been losing on the refinery business for 2 years in a row. Ever since they bought it back in 2007, it made a little bit of profit, but it was still a slight margin to their midstream businesses. And finally, this year, November, the CEO decided a completely sellout, total exit. They're not going to do it anymore, which I think is a beautiful direction. And there's just some quotes I put out there. And there's no liability. They eliminated all liability to exit. There's no cost to exit. There was a Venezuela deal that guaranteed 750,000 barrels a day to these refineries. They were able to negotiate down to 30,000, and now I believe it's gone. That's like $1 billion liability just went out of the door. So I think that's great position. On top of that, in 2014, third quarter, they're going to complete the phase 1 of the Eagle Ford pipeline, which will increase their total production by 10%, and another phase 2 has been approved, another 30% increase. So management. Bill is the chairman of the board. He's like a star CEO, maybe a little overrated on his behalf. Harvard Business School rated him like one of the best CEOs in America. 720% growth and blah blah blah. But he's a good guy, so we like him. Kurt, we like him also. He's been CEO since the inception, but he's getting out of the way. He's retiring, which I feel a little sad, but nonetheless, they chose a good guy. That's the main point. They chose a good VP, which is going to be the CEO, and he's been in the business for 20 years with these guys, so he knows what's going on. And I just like the focus. New Star is very conservative guys. They're one of the safest companies. It's been rated as out there, so I just give them A- on that. And this is where I want to explain why we're buying the GP company but not the LC company. So as far as I understand, even if the LC company is losing money, the GP company doesn't necessarily lose money. So like, I don't really understand that stuff, but just look at the two charts, right? They correlate exactly like it is, but the GP company gets more profit. So I think it's a pretty easy understanding. And I have the balance sheet as an appendix. These are just what I extracted from the balance sheet. You know, if looking at the Newstar Holdings balance sheet doesn't make sense. 88% profit margin. So I just didn't really look at that. But looking at the Newstar's balance sheet, you know, profit margin is not that high, 1.19. Their competitors about 3 to 20%. However, like I said, they're dropping that asphalt refining business. I believe their profit margin is going to increase up to at least 12%, something like that range. Same thing as EPS. Right now it's 0.5, not even $1, which is pathetic, but it's going to increase. That's my thesis. And for price, this is a DCF. I know it's not accurate because there's too much variables to consider, but nonetheless, I like the fact that DCF walk you through the understanding of the cash flow, right? So I chose this one versus all the other competitors simply because of one reason. The EBIT is crazy high compared to all the other ones. Some companies have a huge depreciation, very little capital expenditure. That inflates the DCF. Some company on the other side have a great net working cash flow. That inflates it. But I believe the most important factor of the DCF is the EBIT. You know, if you have a strong cash coming in every year, that's where you want to go. So I won't go too much in detail. I have an appendix if anyone wants to understand it. And on top of the DCF, I reversely calculated at current price how much into the years, into the future, the sum, the exit multiples, as 18.9 years, which I believe is pretty good. I did the same for PAA, for McGallen, for KMI, and they're all over 30. So at least, I don't know if this is a standard metric in the industry, but the way I did it, they seem pretty cheap. And the last thing I want to say is they pay great dividends, 8.4%. You know, that alone is like the cost of capital of our portfolio. So I feel like the dividend structure of this is great. So the margin of safety on both the value of the shares and the dividend payout. So the overall rate is A-. And quickly go over through Parker. So Parker has been in business since 1930, so it's almost 100 years, and they only have 1% of our domestic market. The majority of their business is in the international market. However, that's very volatile. So if we look, you know, majority of the margin is coming from U.S. drilling and rental tools, which is still majority U.S. But you know, majority of the revenue is actually coming from international drilling. Some of the company, this is the CIS, means Russian state, I think. So it's been negative for Asia Pacific and the Middle East. So it's very volatile. Their share was able to increase quite a bit just the last quarter because those sector was doing good, but it was down the quarter before that because those quarter was in wars. So I feel that was not a good standing position. Management is fairly new. All the ones I found on their website joined the company around 2010 or 2011, which I feel is a little bit weak. I'm nitpicking, but you know, I feel that's a little weak. You know, it's like almost like a retirement home for all the other CEOs. So on balance sheet and price, I did a DCF again. The only thing, when I did the DCF, I had like negative 0.8 for the suggested price. So I had to assume a 2% perpetual growth, which on the Newstar, I have to assume 0 perpetual growth. And with that 2% assumed, I was able to get $6.13, which is still lower than the current value, by the way. So my thought was that, you know, the original thesis we had was there was a market overreaction. The stock has been overselling. You know, it should not worth $4. It should somewhere around like $6 or $7. And so that thesis has been realized. That was my main sell point. So the thesis was realized. You know, it's a volatile business. It's a weak domestic market. And there's no dividend at all. Versus on the Newstar hand, there's a. So we know this is a given, the best dividend. But these are my theses. If these two can be realized, there's no question that Newstar will be a real star, I guess.
Good job. Questions? Who wants to end up in a CEO retirement home?
Does, Newstar have any transportation or by rail?
No, it's usually by the pipeline. They do have cars, like big tankers, but they say that is the most inefficient way and like even more expensive way to transport. But they do that right now because of the high WTI and Brent spread. They want to lower it down, so they use trucks right now, but that's not their long-term strategy. Pipelines and pipelines.
What is the distribution coverage for the LP?
Let's go back to that first slide. Sorry, that was not the appendix. So that, I think that was quite complicated. We'll figure it out. I can't read it, but I think it's 2% general partnership through that, and
No, what's the what's the coverage there?
I think around 30%. I'm not sure. I think it add up through all the other holdings about like 30 to 40%, something like that.
So for
Go ahead.
Parker Drilling, it seems to me that you're accurate on the thesis has been realized for Parker. Is there any new thesis on Parker that we might be missing?
On Parker, the guy's retiring. The only guy who has been in the business for like 30-something years. Parker himself, the grandson of the farmer or something, he's retiring at the end of this year, which I feel is like the only knot tying together all the pieces. And it's like the fall of the Chinese dynasty. When the one guy dies, it's gone. So
your friend Bill owns 20% of the GP. What are his plans? What's going on with him?
he's not retiring, I think. He's still sticking around. I'll be honest, I can't answer that question. Like, all I knew is I researched into the management. What I did is I read through all the Q&As on the earnings, and Bill didn't really talk much. It was Kirk who said all the questions. It was very clear. It seems like Bill is like the overheading guy. I think he's still more participant on Valero. Yeah, Valero, yeah. He's still more involved in Valero versus Newstar, but he's overseeing both of them.
Is it a concern that the PE ratio is really high?
I actually asked Mr. Keating about the PE ratio, the first thing I chose Newstar. He says on a MLP, the PE is less concerned than the dividend payout ratio. The PE for Newstar is about 50, but the PE for NSH is only about like 20. So you could take that into account. And also that's, I believe, the EPS will increase significantly. So that will bring down the PE.
Questions? Thank you.
All right, thanks.
On to Tech and Telecom.
All right. Edicts, just announced.
Thank you.
CEO resigned.
Oh boy.
You have your Google alerts set in case something happens?
I'm super worried, so it will.
Make sure it's on. It's a green
Is that
light
good?
on. Yep.
Or put this down.
Wherever pocket it's easier.
When I get the questions, I'm ready to refer to it.
For sure.
How do I,
Just take the
Just forward.
Forward.
We should be there.
okay.
One more. When you're ready.
Let's do it. 1, 2, 3. Good morning, everybody. My name is Jonathan Keebor. I'm part of the tech and telecom sector, and I'm going to be presenting eBix as the buy. No one's ever heard of it? Great. And or maybe you have, that's bad too. And SanDisk is the sell. So, I just want to say first off that the tech and telecom sector was crowded with a lot of blue chips. It was very hard to find something that we didn't already own that was like a big slugger. So what I did was I played in the dirt, and I tried to find really good value, even if it's a little contentious, or even if there's a little bit of you'll see there's a legal snafu here and there that dropped their price. So eBix, eBix does software and end-to-end services for the insurance industry. They do they do a little bit of everything, and they're actually the only company that has an exchange sector, broker system, carrier system, and business process outsourcing. They're the only company that does all four together. It's important to know the BPO wing is actually a cloud service. It's software as a service that they offer. That's important. As you'll see, I'll talk about some of the tailwinds I expect them to reap as a result of that. So in terms of the business plan and why I think they're worth looking at, apart from their fundamentals, which is really the selling point, I think they're just very well positioned to continue to grow. They have very good international sales. They have a lot of their business is registered in India or Singapore, so they pay very negligible taxes. It's very cheap to run, and they're well positioned. They have a pretty good moat, and they sign really important companies for long-term recurring revenue deals. It lasts like 5 to 10 years, so they make a good amount of money. So as I spoke about the tailwinds, cloud services is one of them. The other is emerging market growth. They're already poised, as you see the countries they operate in. They already have operations in India, U.S., Canada. They have a real good market share in Australia and New Zealand, between 80 and 85% of brokerage. The Affordable Care Act, that's right. So the Affordable Care Act mandates that insurance providers provide their clients, or their customers, with certain types of information, a certain amount of information. And right now, given the network and the services that EBIX runs, they're very well poised to grow along with whatever the ACA demands. Not whatever, but I mean in terms of the information provided to insurance purchasers. So they've taken a lot of initiatives in terms of how they run their business. They're constantly updating their technology, constantly retooling their code, expanding through platforms to capture mobile and tablet devices. Their acquisitions have been highly synergistic, usually with big upsides, and they're acquiring strategically across the world. So they've just got something in Singapore, and they just got something in Brazil that's going to be like a majority provider. And they continue to develop their recurring businesses. So this is really important because I'm going to get into some of their legal problems in a bit, which don't worry, I'll assuage all doubts and all fears. But it's important to know that after the big fall that I'll show you in a sec, they were able to sign these companies for long-standing, like 5-year deals. So it's nothing to scoff at. These are all huge companies. All right, so these are the fundamentals. I'm going to get to the crash in a bit, but first I want to go over the fundamentals. This is the main reason I'm pitching this company. I think that if we're in a class about value investing, so let's get some real value out of it. Good, nice low PE, nice price to book, nice price to sales. I think it's just, they had a big crash, so it really dropped things down. ROE and ROA are really nice. They pay dividend. That's a good bonus. Their growth has been pretty good, especially for industry. If you want to look on the sheet, they've been doing pretty remarkable. Margin's okay. Their debt's pretty low, although it's probably going to rise a bit. So for all these reasons, I think in terms of value, not bad. So here we go, there's a crash. Oh, good, what's happening? So they had a price of nearly $20, and what happened was, we'll go into it probably in the questions more. I have a feeling people are going to want to know exactly what's going on. But what happened was Goldman made a bid to buy the company. A Goldman affiliate made a bid to buy the company for $20 a share. They had known about some previous litigation. They were fine with that. Their due diligence said this was okay. They said, all right, let's do it. And then a couple of class action lawsuits came out, and it named EBIX as there was some salty language that I think Goldman got a little worried about it, and they backed out. So they back out, price drops by, it halves, and it's been slowly regaining since. So the funny thing is, if you look back a long enough timeline, you'll see this has happened like twice. Every once in a while, people publish something very scathing about the company, the price drops, it turns out that it's not really true, price goes back up. So it's happened before, twice, it's happening again now. I think they're gonna shoot right back up. All right, so to validate my claim, I did a worst case scenario DCF. So this is everything inside of the line is actually from their balance sheet, and then what I did was, that's actual free cash flow. I took a conservative free cash flow estimate by upping their 10% tax rate to 20%. I also upped their WACC from 11.35 to 20%, and I took these are their actual values, and I slashed them for ribbons to show you what would happen. Let's say they get sued again. Let's say they have to pay out all their damages. Maybe their business goes down by this much. They have their cash flow from operation goes from 28% to 8%. I just straight line their capex, and then I got this conservative, very, very conservative estimate for their cash flow. And then I ran it through, 3% growth estimate. And I took their current liabilities on the 2012 balance sheet and estimated $250 million in penalties. I got that from the internet, a couple of different sources, and I just sort of added a little bit extra to be as conservative as possible. So anywhere from like 150 to 200 million potentially. So I said 250, okay. They pay all of it out, and they come up here at a 4% upside in the worst case scenario where their tax doubles, their whack doubles, everything gets slashed by half. The business flounders and they still somehow make us 4%. So the thing that happened was after Goldman pulled out, immediately EBIX got on the horn and announced, okay, well we're gonna throw out a $100 million share buyback. We're gonna prove all of the naysayers wrong. You say we're not a real company. We are a real company. Here's how we're gonna prove it. So let's say they buy 100 million back using the prices at close. We're potentially seeing a 12% upside if they get that done within like a year, which they probably won't. It'll probably take 2. But the thing about their buybacks is, yeah, announcing a buyback doesn't mean anything. But the last time any buyback they've ever announced, they've gone through it. So they've done like 80 million in buybacks in 2 years. All right. So SanDisk, this is my sell. SanDisk is a hard company to sell because, to be honest, it's a good company, it has good management. There's nothing wrong with SanDisk. The thing is that we bought them when they were cheap. They were cheap. Now they're not cheap anymore. They're just at the end of what they were intended to do. So if you don't know what SanDisk is, basically they sell those little chips you see in cameras, and they sell memory. They sell NAND memory. NAND is just a type of logic gate in their circuit. That's what they sell. They're also now moving into something called solid-state drives. Solid-state drives are like a hard drive on a computer, except they're faster. They're usually lower space, but they're great. The thing about it is, I like what they make, but what they make isn't unique. Everybody makes what they make, and Samsung makes everything they make a lot better. So there you go. In terms of NAND, their NAND memory, Samsung is killing them. They're not even in here. They're lumped into the 90% other. In terms of the pretty new SSD market, they're doing okay. They have 17%. So the thing about SanDisk is, it's a technology company, and after enough time, all technology gets cheap. And I think technology is getting cheaper faster. So their margins are about to squash. If we ignore the aberrance of anything happening before 2009 when they weren't very good, if we look at when they were operating really well here, you'll see they shoot up as their NAND memory, before it's highly easy to imitate. It shoots up and then margins squash, and they shoot up again with the SSD stuff. And I think that it's gonna taper right off. I just don't see. Other people are coming in every day making new SSD devices. They're making them with new functionality. They're doing different things. There's a company selling them filled with helium, so they're even faster than they were before. And SanDisk just isn't really doing that. They're like, oh, we're gonna invest in this one idea, and then they sit on it for a while, and then they move to something else, and they sit on it for a while. They're not super innovative. So I think their moat is pretty weak. People can chew them out easily. As you see, they did 50% since we bought. Since year end or year start. Not bad. So overall, I just want to reiterate that I'm aware EBIX is a weird sell. I'm aware that the litigation and the SEC probes make them seem bad, but we can go into it in the questions. A lot of the SEC probes come from things that have been debunked. I don't think they're going anywhere. The lawsuits so far, they have like 2 outstanding lawsuits that have just been sitting around for 2 years. Nothing happens. Even if everything goes belly up, they're still going to make money. It's just too cheap not to buy. So that's, you wanted value, here you go. In terms of SanDisk, I think it's a great company. I think what they make is, they make a good product, they just don't make a unique product. Their moat is slim and competition's fierce. 10 seconds. Yeah, it's good enough. So I have I wrote out all their litigation history. If you guys want to go with that, ask away. I'm going to need to reference my papers though, because it is.
All right, thank you.
Here we go. This is the hard part.
Who wants to get into the legal?
Yeah.
Corporate buybacks, in my estimation, aren't enough to bring me into a stock because companies oftentimes are very bad market timers. We look at Cisco Systems and Microsoft in 1999 and 2000. Have you seen any insider buying activity? That, I think, is a better indication than putting your own skin in the game when the stock be very depressed. Have you seen any SEC filings?
What I've seen is that the CEO, Reyna, hasn't divested himself at all. Whereas actually SanDisk, I forgot to mention this, SanDisk has been, their upper management has been selling stocks off. That to me was a little worrisome. Also, sorry that I forgot this, but SanDisk also initiated or announced a $1 billion debt purchase. So that's going to be blowing up their books as well. But yeah, in terms of like executive ownership, I haven't seen any growth. I haven't seen any changes either. It's been sitting exactly where it is.
And what percentage does current management own?
I think Reyna has it's something like 9 or 12. I might be mistaking one for the other. It's somewhere in that level, but it's been sitting there for definitely a year, and I think it's 2. I think it's been there about 2 or 3 years. It's been sitting at that level. Yeah.
So beyond the stock price being depressed by legal issues, have
Yeah.
you seen any business affecting any other parts of the business or decisions about anything?
Right, that's the thing. So, where did I put the clicker down? Okay.
Right there.
So, as I mentioned before, the purchase went kaput, the price halved, and then regardless of that, they're signing. These are the guys they're signing. The investor call they had after the blow up. The CEO comes on. He's like, "Well, here's some new business we signed," and he just drops these guys. They have like 70 Fortune 500 companies. And they just keep throwing them in. I don't know how they do it.
Yeah, do you have any insight on it?
No, they don't. He doesn't go into it. He says, "This is what we signed. These are the deals for how long we signed them." He hinted at some stuff. That purchase they did in Brazil. U6 is a Brazilian thing they bought. They've claimed that it's going to be a market leader and capture some outrageous percentage of the market there. They also had a deal with Intel following, or right around the time of the Goldman thing that went belly up. They secured another deal with Intel. So I don't know how they do it, but a lot of the legal allegations are, oh, you're a house of cards company. You're not really, we don't believe any of the numbers you post, but they have real customers and they spend real money on things. So I don't believe it. I've also read, I have rebuttals to literally all of those articles that refute their stance as a company. I can go into it if anybody cares. But as far as I can tell, it's pretty baseless. And I think the market's going to reflect it. It keeps happening. Someone, there'll be like a big short position, an article will come out, it'll plummet, all the shorts will move out right back up, and then they just do it over and over. So, yeah.
I don't know what the lawsuits are, but generally the lawsuits could be disruptive. Something like, for example, Samsung in that case, everybody thought that Samsung has to pay amount back in their IP case. So, like that new revelation models, could you set aside any money for these lawsuits? Could be detrimental.
Does the company do it?
Worst case scenario in the growth rate and those things. But what if they need to pay an amount back to their lawsuits?
They need to pay what back? Sorry.
So any damages, the lawsuits.
Yeah. That the $250 million in the DC,
Which is roughly half their market cap?
where are we? There we are. Yeah. That's the assumption is that they're paying that out in the DCF. That's legal damage. Is that all right? All right. Yes, sir.
I looked
Here we go.
search EBIT and it appeared on the S&P 500 most heavily shorted stock.
Oh yeah.
46% short interest.
They get short. They get
How
shorted
can
a
you,
lot.
maybe explain that a little bit? Why do you think everyone's shorting this
Right.
idea?
So the way I look at shorts is it's like this. People either short a company because they don't think it's going to do well, or they short it and then make it. So they don't make it, but they influence the market so that it doesn't do well. I think let me, if you will allow me. The last 2 times there was a short volume like that, there were two articles now, published on Seeking Alpha. One was from Copperfield Research, totally debunked, same thing happened. The other was from Gotham City Research. The thing about it, they're all anonymous, they make anonymous claims, they write like 3 articles on Seeking Alpha and vanish. They never write anything, they've never written anything before, anything after. And the market reacts to it, and the SEC, and then there'll be a class action suit here and a class action suit there, and they never seem to really amount to anything. I'm not saying these things aren't there. I'm also not saying that they aren't a little bit shady. What I'm saying is, I'm aware this stuff doesn't happen. You know, it's not like wrong place at the wrong time. They're probably doing something that people don't like. I don't care. It's too cheap. You can't not buy it. It's too cheap not to buy. That's what I'm saying.
So what's the relationship between the Rennis Foundation
Here we go. Yeah.
and the management?
So the
Like,
Rennis Foundation-
what's going on with and then I guess the second largest shareholder, Pentwater Capital.
Yeah.
What's their story?
Why would you do this to me? The Rennis Foundation has an explanation. Pentwater, I'm not so sure about. As far as we could tell, and as far as I can still tell, they're just a hedge fund who buys them for some reason. They had a lot of very strange things. Okay. They don't seem. I haven't seen anything that.
Have they made any public statements? They're almost 10%.
Yeah, not that I've seen.
Okay.
So the Rennis thing is important to address because the Rennis is this weird company in like Luxembourg or something like that, and they seem to only invest in companies that have that are in like these very gray legal areas. So the thing is they're getting lumped in with this negative history of Rennis's investment, but Rennis, they don't have any other affiliation. The only affiliation they did have is they had like a debt purchase for $5 million or something like that, like it was a zero interest rate, zero coupon debt purchase, and that seems very strange. But it was under some I don't understand the mechanics of it, but it was the deal was done under like a FASB rule where there was a money, like it was worth something to the people doing it. It seemed like someone was just getting lent money for free, but that's not the case. It was under some very strange FASB rule, which I read about. I don't remember the name. I should have written it down. I'm sorry. But that was above the board. That's something that I've read analyst reports and like, no, that's clean. It just looks strange to Americans. All right. There was a class action, or not a class action suit. There was like a probe regarding it because the SEC doesn't like that foundation very much, but they haven't turned up anything. EBIX has disavowed that there's any wrongdoing. That was like 2 years ago. I think it's dead in the water. They just don't talk about it.
And that's unrelated to management. Management's a separate deal. What percent of the company does management own? What have they been doing? What's management's story?
Oh, wait, Rennis management or EBIX management?
Sorry, EBIX's management.
They own something like 9 to 10. No, sorry, they own 12 and Rennis owns 9 to 10.
Okay.
And it's been about that way. I checked in 2009, that was the same thing.
And are they, what's their background? How do we know that these are upstanding individuals?
EBIX.
EBIX.
Okay. Well, the CEO is Robin Reyna. He's been featured in a lot. He's one of these, he's very polarizing. People either really like him or they really hate him because he seems to take a lot of risks to do a lot of things innovatively or, not according to the books, not as you'd expect. So I've seen as much consensus in favor of what he does as I've seen consensus saying, oh, this is a house of cards. So that averages to nothing to me. That's the thing though, if you have such a disparate public sense of a CEO, if you're not landing anywhere, he's not totally bad, he's not totally good, he's just a person. Management I think is their weakest point, just because they seem to have done things not carelessly, but in a way that they don't like take into account the effect it'll have on their image. So I acknowledge that is to their deficit. They're cheap, very cheap. Any more?
So the executive summary, the 5-year price for the buy and sell executive, buy is 79%.
Right. Yeah. The 79% is my estimate for end of next year. For the sell, that's like the maximum upside taken from Yahoo. I don't buy that. It's on there I just wanted to show the disparity between what I think is going to be like a very reasonable estimate for my buy and an unreasonable estimate for the sell. But yeah, they're way off. Anyone else? Yes, sir.
Does EBIX have any part involved here at all?
Do you mean in what sense?
It's software and it's health insurance.
Yeah, it's health insurance software. So basically, when a company a company that needs to roll out an insurance system, EBIX can design any piece of it or all of it. They have one of the things they tout is they have a full end-to-end system, full customer integration. They can do all of it. So it's not that they have it's not that they have an influence in Obamacare, it's that they're very well poised to react to whatever, to the needs that Obamacare will demand of insurance providers. So the thing is that if they have, say they have a long-standing, like a 10-year relationship with an insurance provider, and now that insurance provider has to change whatever it does and do all this, they're very, I mean, it's a software company, all they have to do is fix all their software. And this is what they've been doing, and this is what they can continue to do quickly and effectively. All their systems are integrated and cross-linked through one another, so the process will flow through. So the more well integrated you are through eBix, like the more of eBix you allow to integrate your service, the easier it is to roll out new products or to change with Obamacare. Yeah, this is awful. Yes.
My question is there anyone doing what eBix is doing, and what kind of differentiates them?
Yeah.
Are the other companies as
shady?
Yeah.
Probably not. I'm being honest. I'm aware of how this works. Cheap. So the question was, what does eBix do that the other people don't?
Yeah. Is there people doing what eBix does?
Yeah.
What kind of difference?
They don't do this comprehensively. People do pieces of what eBix does. eBix does all of what everybody else does. eBix also has, it's a pretty old company. It was founded in 1970. It's pretty old. They've been doing this for a while, and they already have contracts locked in with some of the big players like Pfizer. All those guys, they're not going to move. The other thing is that once you have a system like that, the reason their revenues are so highly recurring is because what are you going to do? Your whole system is on it. It's like Oracle. Sorry, Char. It's like Oracle. Yeah, well, listen, I've got to dig myself out of this hole. It's like Oracle.
Great company.
I'm sorry. Once you're integrated, you're not going to divest yourself of that. Especially if you've been with them for 5 years. Like they signed a contract, they're already in. Yeah. Charlie, you want to bring me down? All right. Why? Yeah.
What are these shady activities?
The shady activities are it's not. So this is it. Their shady activities are mostly that Rents Foundation thing, and the fact that they have all of their IP is in Singapore. A lot of their revenues most of their revenues aren't recognized in the States, so their tax rate is like 9%. So what happened was in the Gotham article that came out on Seeking Alpha, they said, okay, first of all, there was this weird discrepancy between 2010 and 2011 bookkeeping. It's very clearly explained in the book. The Seeking Alpha article said, you took 67 million of Singapore revenues and you hit it. No, they didn't. It just changed line items, and it's very clearly explained. It's literally English and math, and they didn't do it. They just didn't do it right, and then announced it, and then people freaked out. You can read. I can give everybody the Gotham article, and then the point by point rebuttal.
All right, I'll ask the last question here. Maybe just to elaborate further on, what they do.
Yeah.
They have these new customers that they just signed up, which you listed there.
Yeah.
Do they give specific examples of what they're selling these people and how much?
No, they don't. What they did say was in the Q3 call, Robin Reyna pointed to the fact that they're signing somebody who could potentially come in and become their number one client. So it seems like they're about to, not double, obviously not double, but it seems like they're about to add significant revenue. That's the only thing he said. In terms of the actual service they provide, no, they don't tell you the granularity of like they want the software as a service, or they want the brokerage, or they want. I mean, I have some numbers about the amount of brokerage they do and things like that. Mm-hmm. They have like 90% of online annuities worldwide. So they have these very strange market shares where they have like 90 or 85% of something specific. It's not that it's a huge market, but they have like control over a specific set of insurance services worldwide too. It's like not just in the States. Anyway, yeah.
Final question. Do you put your money in the stock?
Yeah, I would. I definitely would.
Are you?
For like a year. I don't have any money, but I would. On Thanksgiving, I went around to all my family, like, hey, listen, I got a hot stock tip. And everyone's like, get out of here. You grew up with you. They're not giving me money.
All right, on that, thank you.
Well done.
Was it? Thank you.
Thank you.
Oh my goodness.
All right, we're a little ahead of schedule, so let's take a 5-minute break and be back here so that everybody can refill and refresh.
Yeah, well,
hey, good to see you. Yeah, good to see you too. Jonathan, have you seen today?
You did that on purpose. That was mean.
But It's fine,
What?
in the lounge, during the
That's
lunch.
the CEO.
Okay, yep.
Yeah, I know what he looks like.
He even looks
So
shady.
It's a goatee, he looks like the devil.
Send an email, instead of
Is that all right?
Yeah, I don't know what's going on.
Yeah, this is fine.
Yeah, that-
Oh,
yeah,
well done.
yeah,
Well done. Well done. You know, it was
'Cause
good.
I know there's
Oh,
a
we gotta
lot.
give you a hard time just because you know.
Oh.
We have to give you a hard time.
You should though. They're it off.
I already talked with
Like doing their man.
Said,